Listed REITs have recently transitioned from recovery into expansion, but expansions usually last around 12 years. Why do they last so long? It's just not about price returns. It's also about underappreciated income returns. So we think this is actually a really interesting cycle. If you think you've missed the bottom, you haven't. This is going to play out for a long period of time.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. Today on the podcast, I'm pleased to welcome back Rich Hill, Global Head of Research and Strategy at Principal Asset Management. Rich is here to highlight some of the main themes of Principal's mid-year update and help us understand the backdrop for REITs and commercial real estate today. Rich, thanks so much for coming back on the podcast.
Thanks for having me. I think the world's changed a lot since the last time I was on, so looking forward to chatting with you.
Definitely. So, Rich, as we sit here today, how would you say that the more volatile geopolitical backdrop seen in the first half of 2026 has shaped your outlook for the global economy and commercial real estate?
Yeah, sure. So variety is the spice of life, I think they like to say. The world feels a lot different than it was heading into 2026. The reality is inflation is higher, interest rates are expected to be higher, and growth is slowing. In isolation, I think that maybe leads some people to think that would be bad for commercial real estate. But I think we have a much more different view than consensus. What do I mean by that? First of all, I have to acknowledge that if the world feels unusually chaotic, you're not making it up. And I don't have an edge on telling you how to play macro or geopolitics. What I do think commercial real estate investors should do is focus on maximizing what they can control, which is net operating income growth. And we think income-driven total returns are going to be a very important part of this next cycle. In reality, the market has forgotten about that because over the last cycle, income was only less than 50% of total returns, but historically, it's closer to 85%. And maybe even more importantly, I think the market's learned over the past 3 years or so that interest rates are all that matters for commercial real estate. But we don't think that's the case. And at the risk of front-running our conversations here, we think what's happening with listed REITs this year is a really important signal the public markets are sending. Look, U.S. listed REITs are up more than 19% year to date. They're the fourth best sector of the 11 S&P 500 sectors. The market is telling you something that predictable earnings and income-driven total returns are becoming more attractive again. That's been out of favor for the past several years, but it seems to be a little bit more in vogue right now. So I'll pause there. We can flesh a lot of these topics out.
Right. And you point out that the CRE recovery remains intact even as investors have become more deliberate. Would you say that there are certain indicators that give you the most confidence that the recovery is continuing?
Yeah, sure. We look at a variety of different indicators. At the very top of my list, I cover the 4 quadrants of real estate investing at Principal, which is public and private equity and debt. At the very top of my list is the U.S. listed REIT market. And as I mentioned previously, U.S. listed REITs are sending real significant signs of resiliency. But the private market continues to send signs of resiliency as well. We received preliminary marks for the NCREIF Odyssey Index last week. The NCREIF Odyssey Index tracks 25 open-ended funds that own core commercial real estate. Gross total returns were up almost a 1.5 in the second quarter. That's a pretty strong quarter for the NCREIF Odyssey Index. And the other indices are also sending positive signals as well. But away from that, I would say the third most important signal we look at is what's happening in the debt markets. The debt markets are very open and liquid right now. There is a variety of lenders, whether it be banks or insurance companies or CRE debt funds, that are actively lending in this market right now. I think what's happening with banks is even more interesting. In fact, they're no longer tightening lending standards as per the 1Q26 Senior Loan Officer Opinion Survey, and they're becoming less restrictive at a time that they're becoming even more restrictive on traditional C&I loans. What are 2 other factors we're looking at? I would also argue the transaction markets have held up pretty well. In 1Q26, they were up more than 20% on a year-over-year basis. 2Q26 is going to be a little bit more volatile, but we're seeing something interesting happen in the transaction markets. While individual property sales are down, entity-level and M&A transactions seem to be stable to up. And that actually has important implications for the U.S. listed REIT market. The final point I would make, and then I'll get off my soapbox here, is that the debt markets, I think, often misunderstood from a distress perspective. We actually think distress is a lagging indicator. Distress is the last stage of the grieving process, which is acceptance. Banks do not like to resolve distressed loans into a distressed market. They like to resolve distressed loans into a stabilized market. That's exactly where we are now. So I wouldn't be surprised to see distress remaining elevated here, but that's a contrarian bullish signal. So taken in totality, we think that this is the market that is actually continuing to move from recovery into expansion, as evidenced by what's happening in the U.S. listed REIT market right now.
And your outlook also says that the recovery is better described as K-shaped rather than U-shaped. So
Yeah.
where would you say you're seeing the greatest divergence across property types, markets, or investment vehicles?
Yeah, so let's talk about this recovery. I think the consensus has started to understand and acknowledge that this is a so-called K-shaped recovery, where the top quartile of property types across markets are doing quite well, and the bottom quartile across markets are not doing that well. And you can look at a wide variety of indicators. I like to point to the industrial market, where weighted average sector returns in the private market are up a little bit more than 5%. Some markets are up more than 40%. Other markets are still barely up from their trough. We think that's not a flaw of the cycle. It actually is the cycle. But Sarah, there's a really important point here that we're beginning to hammer home. And it's where I think consensus might have the story a little bit wrong. In returns for commercial real estate has always existed. But the market has forgotten that dispersion of return matters. And the reason the market has forgotten that dispersion of return matters is because in a broad-based expansion where everyone's making money, no one cares about dispersion. In a broad-based downturn where everyone's losing money, no one cares about dispersion. And the last time we had a recovery was a V-shaped recovery post the GFC. So it's really been more than 30 years since the early 1990s that the markets had to confront a backdrop for commercial real estate like this, where picking the winners is just as important as avoiding the losers. So I want to make sure that was understood because I think it's really important. But I want to come back and answer your question about where we're seeing the greatest opportunities. As an outset, I would say that it is hard for us to look at any single property type and say we have significant overweight conviction. At the same time, we tend to not redline any property type or any market. What we think is a market where picking the right property types in the right markets increasingly matters. And that's because there is significant dispersion in return forecasts over the next 5 to 10 years. So what do we like? I'll give you just a few themes. Everyone likes to talk about data centers right now, and so I'll lead with that. We think the data center market is no longer a monolithic asset class. You're starting to see significant differentiating between property types and data centers, whether it be a cloud data center, an AI inference data center, or a generative AI data center. We tend to like cloud and AI inference, while we're much more cautious in generative AI. But the market's beginning to differentiate between the different markets that you can invest in data centers. In the United States, we probably like 10 markets. And we increasingly like markets that are what we refer to as availability zones. That's with a lowercase a, not a capital A. An availability zone is effectively where you have a cluster of data centers and a cluster of clusters. And many of the hyperscalers need that redundancy. And so we think those markets that are in availability zones are increasingly scarce from not just a land perspective, but from a power perspective. But where the data center market is becoming increasingly interesting is how much tiering there is in cap rates based upon lease structure. 3 years ago, I probably would have told you all data centers trade at a 6 cap. Now we see some data centers trading at 8 caps, and we see some data centers trading at inside of 5 caps. So we like that. We think that is a real significant opportunity in the data center market. We happen to be developers in the United States because those are the most attractive risk-adjusted returns. Let me pause there. I want to talk about the housing market because I think the housing market in the United States is a really fascinating opportunity. The consensus believes that the U.S. is underhoused by, pick your number, 5 million homes, 6 million homes, 8 million homes. That is mathematically true, but it actually might not be the right debate. We think we have a housing mismatch in the United States. We built too many houses of certain types in some markets and not enough houses of other types in other markets. That's a long way of saying if we're 8 million houses short in the United States, you don't solve that by building 8 million apartments in Seattle. You have to really think about what markets have been oversupplied and what markets have been undersupplied. There's a chance that Class A apartments in the Sunbelt markets have been oversupplied and will continue to face headwinds. But there's actually something even more interesting happening in apartments, which is demographic shifts. We don't think investors have spent enough time understanding how the population is aging in different ways. So the plus 70 age cohort is increasing, and the plus 35 to 58-year-old cohort is also increasing, while the under 25-year age cohort is flat to down. What that means is that we need more rentership units that are built for families and less rentership units that are built for individuals. That's a very long research way of saying we might need more 2 and 3 bedroom apartments and less 1 bedroom apartments. So putting this all together, when we think about housing, we think that you need to think about this from a diversified housing strategy. You can't just buy Class A apartments anymore. We selectively like Class A apartments. We like markets where you can buy a Class A apartment well below replacement costs and underwrite the right rent growth. But there might be some other Class A apartments that are not attractive here. We also like build-to-rent. We think build-to-rent is a really attractive strategy. We selectively do manufactured housing. We think senior housing is an important part of the housing complex, given what's happening with the plus 70 age cohort. And finally, I would say as much as student housing has been out of favor, there are some student housing markets that are really, really attractive. So we think to be successful in what we refer to as living, you need to think about the complete horizontal of opportunities and look at this on a market-by-market basis. You can't generically be buying Class A anymore. You need to think about what Class A markets for apartments are really attractive and where you might be looking more for build-to-rent. So we really like those 2 strategies a lot. We haven't talked about things like retail or office. I'm sure you want to get to office, which I think is a fascinating asset class. But let me stop there and see if you might have any questions.
Yeah, I just wanted to ask you about the regulation on the single-family rental sector. What impact do you think that's going to have?
I think it was an overwhelming positive or relative to where we were a couple months ago. So what did regulation do? It did 2 really important things. First of all, it preserved build-to-rent for institutional investors. We think that's really important. We believe to solve the housing unaffordability challenges that we have in the United States, and those are very real, we need to build more of what we don't have, not regulating what we do have. So build to rent is an important part of creating more affordable housing for a broad-based section of Americans. That is really important. The second thing that housing legislation did was it still allowed, in some ways, for institutional investors to continue to own single-family rental homes. They don't have to divest of them, and in fact, they can continue to buy and sell them with other institutional investors. To be clear, I think that's a smaller portion of the single-family rental market. If you look at what the publicly traded REITs are doing, they're increasingly not buying what we refer to as scatterplot single-family rental homes off the BLS. They're doing build-to-rent. So we think the future of the single-family rental market is build-to-rent, and the housing legislation did preserve that. It will be very interesting to watch how the Treasury actually implements this legislation, because the bill itself is just the beginning. It's not the end. Now we actually have to get into crafting how the legislation will be implemented in a real world setting.
And Rich, office, obviously that's been such an interesting topic for a long time, but things look a lot more positive.
Yeah, that's undeniably true. It looks like the recovery across U.S. office is expanding. And as I think about the U.S. office market, I always go back to one of my favorite statistics from JLL, which is that 90% of office vacancy is concentrated in 30% of buildings, 60% of vacancy is concentrated in 10% of buildings, and around 40% of buildings have no vacancy whatsoever. So if you were to ask me, what does this really mean? I think the top quartile of office properties in 10 years' time will be viewed to be a very attractive investment opportunity. We're probably not the biggest buyer of office in the private equity space right now, especially for core commercial real estate, because the market is still trying to figure out how much CapEx you have to spend to preserve the value of properties. And so we'd rather have a little bit more predictability. If we were to play office in the United States, we'd play it 2 ways. First, we think the U.S. listed REIT market is increasingly attractive for U.S. office. And that's because I can buy select U.S. office REITs trading at pretty significant discounts to the replacement cost. That's just a long way of saying the public markets might be throwing the baby out with the bathwater. So we think office REITs could be an interesting way to play that. And we actually really like lending on office right now because we think those risk-adjusted returns are really attractive. I'm often asked, okay, Rich, you just told me not to buy private equity office. If I had to buy private equity office, where would I do it? We actually think Europe is really interesting for private equity office. We can go into select submarkets within London or Paris or other markets and buy really attractive buildings that have attractive risk-adjusted returns. In fact, I would say in Europe, my views might be different. We see better opportunities in private equity than we do the listed REIT market. So there's just a compare and contrast, and I oversee a global research business. So I think office is one of the most fascinating asset classes where you can actually take a global perspective and really begin to add some alpha to your portfolios.
And Rich, from everything you've said, it looks like this dispersion in returns is going to be a continued theme.
Without a doubt. And investors are going to have to recognize that this cycle is really about picking the right property types in the right markets. That's a big difference than prior cycles. I like to tell people that prior to the great financial crisis, it was all about picking the right markets. And so long as you picked the right markets, regardless of what property type you owned, you did pretty well. Post the GFC, it was all about picking the right property types. And regardless of what markets you owned, you did well. So it was basically long beds and sheds, underweight office and retail. This is much, much different. It's sort of going back to basics, where you have to pick the right property type in the right market. And not only that, but you have to make sure that you're managing these properties really well. This is a market where we say alpha is earned, not given. And a lot of it comes back down to just significant dispersion in rent growth projections over the next 5 to 10 years. You can look at that for apartments. You can look at that for industrial. You can look at that for office. That sounds scary on the surface, Sarah, but in reality, that's a tremendous alpha opportunity. I like to joke to people that in the broader equity market, equity asset managers pick the right sectors and then pick the right stocks in those sectors. That's all we're suggesting with the private real estate market and frankly, the listed REIT market. There is significant alpha opportunity here. And so that's going to be really exciting over the next cycle.
And as you mentioned in the outlook, REITs and their integration with private equity has been seen to optimize portfolios. Do you expect to see increased REIT integration with private equity as a result?
Yeah, let me get on my soapbox for a second. I really bristle when I hear people say I'm supposed to prefer private equity over listed REITs or listed REITs over private equity. I joke that of the 4 quadrants I cover, I consider them my 4 kids. I love them for different reasons, and they frustrate me for different reasons at different points in time. So we think all 4 quadrants have a home within portfolios, and there's times in which you're supposed to be underweight one versus the other. But as it comes to listed REITs versus private real estate, we firmly believe that every private real estate investor is supposed to have call it a 10 to 30% allocation of listed REITs. Why is that the case? The easy answer is that listed REITs are liquid. And I think private real estate investors have learned some hard lessons over the past 3 years about liquidity. When you want to get out of private real estate, it's sometimes hard to do that. And believe it or not, when you want to get into private real estate, it's also hard to do that. There's queues on the way out and there's queues on the way in. So we think the listed REITs can be your liquidity accordion. You're supposed to draw up on them when you want to increase your allocations to real estate and draw down on them when you're supposed to decrease your allocations. But more importantly, we don't think the market spends enough time on how listed REITs optimize private real estate portfolios. Specifically, listed REITs actually reduce volatility. That's a little bit counterintuitive because listed REITs, everyone knows this, are inherently more volatile over the near term. But over the medium to long term, they actually smooth out your returns because listed REITs zig when private real estate valuations are zagging. So we think they actually optimize portfolio allocations. If you just wanted to reduce volatility, I would say have a 10% allocation. If you want it to maximize your Sharpe ratios, I'd say have a 20% allocation. And if you wanted to maximize your total returns, I would say have a 30% allocation. Believe it or not, I actually think a lot of investors are already doing this. Based on my conversations with consultants and larger institutional investors, I think they have a recognition that they're supposed to do that. But I'm going to go too far out here, but there's this new concept called total portfolio approach that many institutional investors are beginning to gravitate to. We think listed and private will become a really important part of total portfolio approach to managing your assets.
And Rich, putting all these themes that we've discussed together, what should investors keep in mind when considering entering the commercial real estate market today, especially those sectors like data centers that have already generated a ton of interest?
Yeah. So the first point is that this is a cycle for selectivity. This is not a cycle where you can play broad-based mega themes like you did to the prior cycle. That's great because that's exactly how you add alpha. The second point I would make is that keep in mind that commercial real estate is an asset class that matters over the medium to long term, not just the short term. And that's really important because we actually think this cycle is in the very, very early innings. Private real estate is still in its recovery stage. And keep in mind, cycles last a very long time. We think they last around 16 to 18 years. Recoveries last around 2 years. Expansions last around 12 years, and downturns last around a year and a half or so. So private real estate is still in its recovery stage. Listed REITs have recently transitioned from recovery into expansion, But as I told you previously, expansions usually last around 12 years. Why do they last so long? It's just not about price returns. It's also about underappreciated income returns. So we think this is actually a really interesting cycle. If you think you've missed the bottom, you haven't. This is going to play out for a long period of time. And the final point I would make about this is no two cycles are the same. But if you squint hard enough, this cycle has some similarities to the late 1990s into the early 2000s. What do I mean by that? Commercial real estate was out of favor in the late 1990s, driven primarily by two factors: rising interest rates as a result of the Russian debt crisis and .com. What's happened over the past 3 years? Interest rates have risen and tech's done really well. Lo and behold, in the early 2000s, real estate, both public and private, had some of its best absolute and relative years, just as the economy was pulling back into recession and risk assets were beginning to come down in valuations. That's similar to what's happened so far in 2026. There's rising risks of a recession. We're not saying there's a recession yet, but there's rising risks. The path is narrowed. But as bloom comes off the AI rose, guess what? Commercial real estate's doing well again. Predictable earnings and income-driven total returns are in vogue again. So I think it's a really interesting asset class. I would go as far to say commercial real estate, if it wasn't one of the most hated asset classes in the world over the past 3 years, it was probably pretty close. That's a good thing if you're looking to get in the asset class now, because in a buy low, sell high, we think there's going to be an allocation shift higher in commercial real estate over the next several years. So it's effectively a boring asset class, and boring is going to become more interesting over the next several years.
Rich, you've covered so many different things today, but any parting thoughts? What particular trends or any developments you'll be watching closely the next 6 months or so?
I think what I'm really watching here, and I know this is a listed REIT webcast, and I'm not just leading with this because of that, but I am really closely following the listed REIT market and helping it inform where we think commercial real estate is going. I don't think you can understate how important it is for the listed REIT market transitioning from recovery into expansion very recently. That's a really important signal that not enough people are talking about. And that is showing you the path forward for the broader commercial real estate market. The final point I would make to all of this, and this is a really important point, everyone likes to talk about the commercial real estate market as a singular asset class. But in reality, it's 18 different subsectors that fall under a broad umbrella. We think that's really fun and we think that's really exciting. And don't discount the fact that the commercial real estate market is not what I referred to as my grandparents' asset class, dominated by things like retail, multifamily, office, and industrial. It's actually become a new economy asset class where nearly 70% of listed REIT market cap is what we referred to as next generation property types. So commercial real estate is, yes, predictable earnings, stable income-driven total returns, but it's also become less cyclical over the past 10 to 20 years as you've had new asset classes like data centers, senior housing, single-family rental come into the asset class. So all of that means is that it's a huge opportunity for investors to look at their portfolios again with a fresh set of eyes and say, does commercial real estate have a home in our portfolio? We think it does. We think it does something different within portfolios. We think it's an interesting diversifier. And the world that we think we're moving into, we think public and private real estate will actually do quite well.
Great way to end, Rich. Thank you so much for your time today.
Thanks for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.